Hi everybody, tonight we are going to cover off the second half of Module 29. We're going to cover inflation and interest rates and look also at short-term and long-term fluctuation in interest rates. Let's get right into inflation and interest rates. So of all the things that can impact interest rates, everything that we've talked about, shifts in supply, shifts in demand, and so on, over time, the most important factors it has actually been expectations regarding inflation. So let's talk a little bit more about how that happens. Well, recall that the real interest rate equals nominal interest rate minus expected inflation rate. And it's that expected inflation rate that we're going to talk about tonight. Now, also we talked about a couple of nights ago the fact that the true cost of borrowing is real interest, not nominal interest. So when you go to the bank and you take out a loan, what they're going to talk to you about is a real interest rate. Let's take an example. If you borrow $10,000 for 1 year at 10%, simple math would tell you that at the end of that year, you're going to owe $11,000. If we put that on a timeline, year 0, 10,000, year 1, 11,000. The real interest rate in this case is a function of expected inflation, so let's look at that. If you're in a zero inflation environment, the real interest rate is going to be the nominal interest rate, or 10%, minus 0, because in this case we have 0% inflation. So the real interest rate equals 10%. If, on the other hand, we're in an environment where we expect 10% inflation, and that's in fact what happens, the real interest rate, so again nominal minus expected, is 0. What does that mean effectively? What's the significance of that? Because you still owe $11,000 at the end of the year. Well, what that means is that if the inflation rate is 10%, the purchasing power of the money that that bank gets back really hasn't increased at all. So it was effectively a zero interest loan. Why is that? Well, the amount of interest that they earned from us, that $1,000 in interest, was all eaten up by inflation. And as we know, inflation eats away at purchasing power. So in this case, the money that the bank got back at the end of the year really reflected effectively a 0% interest loan. Now this works both ways, whether you're lending it or you're borrowing it. If you borrow it, it means that you effectively got a 0% interest loan. If you lent it, it means you gave out a 0%, effective 0% interest loan. Let's talk about expectations of future inflation and what it does to interest rates in practice. Here is a graph that shows nominal and real interest. The principle that's being communicated in this graph is that an increase in expected future inflation, so in this case, if we're expecting 10% inflation, what that does is pushes both the demand and supply curves upward by 1% for each 1% in expected future inflation. So if we start out here in an environment where the interest rate, the equilibrium interest rate, is 4%, and we expect a 10% rate of inflation over the course of the year, what happens is those supply and demand curves are pushed up by the expected rate of inflation. So if you'll notice, start at the top left, demand for loanable funds at 10% expected inflation, all it's doing is accounting for that expectation of 10%. The Fisher effect is a phenomenon established by an economist back in the 1930s. And what he postulated and was able to prove, the guy's name was Irving Fisher, is the expected real interest rate is in fact unaffected by the change in expected future inflation. Why is that? Well, that's because we all build in this expectation of inflation, and the expected real interest rate then is unaffected by what we think is going to happen down the road. The takeaway for this that I want you to understand is that this increase in expected future inflation, thanks to the Fisher effect, is going to increase the nominal interest rate by our expectation of what's going to happen with inflation. Let's talk now about short-run determination of the interest rate before we get into long-run determination of the interest rate. If we start on the left with a liquidity preference model, otherwise known as the money market, You notice here in the short run an increase in the money supply. So now we're talking about actual movement in the money supply. What's that going to do? It's going to reduce the interest rate as we move from MS1 to MS2 because we're moving down that money demand curve. Well, what's that going to do? It's going to lead to a short run increase in real GDP, if you look over on the right. And what happens then? An increase in the supply of loanable funds. Let's take it in a little more detail. So step one, Fed increases the money supply, which drives R down from R1 to R2 on the left. The decrease in the interest rate increases GDP, and we know that because as the interest rate goes down, there will be a greater demand for loanable funds. Those funds will be loaned out, will generate more projects and generate more GDP. And that increases, that increase in GDP generates an increase in savings via the multiplier effect. Remember that increases in GDP have a secondary impact or a knock-on effect on savings. Why is that? Well, because the multiplier says we will save some of what we earn and we will consume some of what we earn. So that marginal propensity to save is going to increase our savings, and that will shift the supply of loanable funds to the right. So in summary, in the short run, the supply and demand for money determine the interest rate. And the loanable funds market follows the money market. That's the key. In the short run, supply and demand for money, so the left graph determines the interest rate. And the loanable funds market follows the money market because R1 and R2 are the same in both of these graphs. Long run, let's talk about what happens here. Well, in the long run, the rise, what happens? We'll get in here. Increases in money raise price levels. Let's take a break there. Unlike the short run, in the long run, increases in the money not only increase the money supply and a shift along that money demand, it actually raises price levels because over the long run, price levels have a chance to adjust to that change in money supply. Well, what does that do? The rise in price levels is going to push MD1 to MD2, going to push out the money demand. Remember, that's one of the factors that impacted the demand for money. What does that do? Well, when we had the initial movement from MS1 to MS2, you went from E1 to E2, so down along that money demand curve, 1. When price levels increase, what happened? Well, we had an increase of rates from R2 back up to R1. So we went from E2 to E3 along the money supply curve. Well, let's take a look at what happens on the right. Well, the increase in R, you can see on both the left and the right-hand side, you have R1 and R2 moving up and down. That increase in R drives GDP back down. Why is that? Well, when interest rates go up, we see decreases in GDP because projects that were affordable now are less affordable. We have fewer projects, less output, less GDP. And what happens when GDP goes down? Conversely to the multiplier effect increasing the money supply, because some of the increase in GDP ends up in savings. And I should have said, sorry, the increase in loanable funds. In this case, when GDP goes back down as a result of the increase in interest rates, what happens? Well, the money multiplier or the marginal propensity to save acts sort of in reverse. GDP goes down. That means we are not going to have that increase in the supply of loanable funds because we're not going to have that increase in savings. What's going to happen is that S2 that you see there on the right is going to go back to S1. So key takeaway here is that changes in M, so changes in the money supply, do not affect the long-run interest rate. Long-run interest rates are determined by the supply and demand of loanable funds and how the supply and demand of loanable funds reacts to changes in GDP. So just as a quick summary here for interest rates in the long run versus the short run. In the short run, supply and demand for money determine the interest rate. And the loanable funds market follows the money market. In the long run interest rates are determined by the supply and demand of loanable funds. Okay, that is it for tonight. I know that's a lot to cover. We will cover this in class tomorrow with some problems. So that's it. Have a great night, and I'll see you tomorrow.